Well, another week, another Pursuit of Progress podcast. As always, my name is Adam here with my co host Ben. Got a really informative, exciting episode today for our audience that is considering investing as far as investment properties, or maybe they already are an investor and they just want to get a little bit more fine tuned on their strategy going into 2024 and beyond. So, Ben, how are you doing, man?
Hey, doing great. I can't believe it's another Friday. We're already back at it and really excited to share one of my stories today on investing and real estate.
So yeah, as a realtor myself, I have a lot of people that reach out to me that are currently homeowners that are just toying around with different ideas. Whether it be buying a second investment property, whether it maybe even be, assisting one of their children to buy their first home. Just
Mhm.
a lot of different ideas that are being floated around. And this is one that we wanted to kind of share with you guys today. That's a real world example, something that Ben, my co-host right here today with you today, is going to share and explain kind of in depth how he was able to do this very recently. And in his case, with basically 0% out of pockets. Ben, I'll let you take the floor and just kind of give us a little bit of a background, if you could, first on kind of the dynamics of the deal and just what got you across the finish line.
Yeah, so growing a real estate portfolio is something that is very important to me. It's something that I've always been interested in. When I was 15 years old, kid you not, I wrote down on my wall on a piece of paper and hung it on my wall that by the time that I was 30 years old, I was going to own my first home. By the time that I was 35, I was going to own 5 investment properties. And so I've always had this vision. Now, some of those goals didn't happen on the same timelines. If you are someone that's interested in real estate, please know that regardless of your income, of your background, this is something that you can accomplish. Now, you are going to have to study, you are going to have to learn, you're going to have to surround yourself with other people that are doing it. But if you are willing to do that, really educate yourself, stay motivated, have a vision. One thing that I always ask myself and a lot of the customers that I work with is, what is the plan? Your plan can be different than my plan, and my plan can be different than the next person's plan. When it comes to real estate, learning how to manage debt, acquire assets, there are so many different ways to do this, but you got to have a plan. And as long as you know what the plan is and you're building and taking steps towards accomplishing that, that's what's most important. To kind of give you an overview, I have a short term vacation rental portfolio in Arizona, and that is a little what I would consider higher risk, higher reward, because it's based on the economy, how much the American consumer is traveling. Different times of year can be a little more seasonal as far as occupancy and rates. It can kind of go up and down. And so I built out this specific side of my portfolio, and that was in a specific market in Tucson, Arizona. And to diversify and mitigate some of the risk, I wanted to also look at other types of real estate in other markets. Now, this is one thing that I am legitimately concerned about owning property and real estate is water. And someone might not think that's a legitimate concern, but when you own a pretty significant portfolio and you're reading all of these reports about being in a mega drought and how the Colorado River is deteriorating. There, in my mind, there is some real risk there. So I wanted to look at some other markets that didn't have some of those same geographical risks. And then I also wanted to look at a different type of housing, different type of occupant. And so what I decided on was looking at opportunities out in Tulsa, Oklahoma. My brother is a real estate investor out there. We've had him on this podcast before. He was our first guest, and he does a lot of real estate investing out there. So that was a great place for me to start. And so what my goal was, on this end of the spectrum, we have the short-term vacation rental housing. Again, higher risk, higher reward. Well, what's on the opposite end spectrum? It would be government housing. And so what I learned and what I was focused on was looking at government housing on multi-unit properties, specifically targeting like duplexes and triplexes. What's exciting about the Tulsa market is that your dollar goes so much further in that Midwest South market than a lot of these other areas. You can go buy a duplex in Oklahoma for 160,000, 180,000, 250,000. You can't do that in a lot of other markets. So when you have a lower entry point, you have a lot more flexibility. You have a lot more ways to kind of accomplish some of your goals. So my strategy was, owning a couple of properties here in the Colorado area. These properties have a significant amount of equity in them. And I learned through just kind of educating myself, also working with specific investors that are my customers, getting mentored and getting guidance from them, really learning how to put my equity in some of these Colorado properties to work for me in other markets. So, what I did is I opened a line of credit on both of the Colorado properties that I have. And now I have access to all of this equity, literally, hundreds of thousands of dollars. And knowing that I'm going to be looking in a market that's much cheaper than Denver, it allows me to be much more aggressive. So I identified a duplex with my brother in Oklahoma. The sales price was 200,000, and it was so undervalued. We pulled the comps on the street that it was on. There were five recent sales, five duplexes, all in the same block that had all sold within the last 12 months. The cheapest was between 325,000 up to 375. So this specific seller, just wanted to get rid of this and dump this property. If I had to go apply for a loan, and if I had to go through that process where I'm going to go apply for a loan, I'm going to send you my pre-approval letter, I need to close in 30 to 45 days, I'm going to get an appraisal, I would not have gotten an offer accepted. So having the ability to write a cash offer made my offer much more competitive. And I was competing against other investors. So to get this offer accepted, we ended up going all the way up to 230,000. It was listed at 200,000. We got the offer accepted at 230,000. Now, I'm not using my money out of my checking or savings account. I did make a cash offer, but the money came from my equity line that I had on one of my properties here in Colorado. So I was able to make a cash offer from my equity line on one of my properties here in Colorado, not using my money, not having to deplete any assets of mine personally, and finance the entire purchase, 100% of it. And I
Awesome.
was able to get the offer accepted. So that's kind of part one. So that's what allowed me to get the offer accepted. It's what allowed me to use 100% financing on an investment property. I was essentially my own bank, and this is a strategy that I use over and over and over again. So this is kind of part one of part two. So there is a second step here that I'm going to go over in just a minute. But does that make sense so far? Do you have any kind of questions on the strategy or what I'm referencing? Is that making sense?
Yeah, it does for me, but for people that maybe aren't that familiar with, let's just dumb it down as much as we can. So, equity, just explain again what equity is, but also how you're accessing that equity through a loan or a home equity line of credit, a HELOC. Just kind of explain that a little bit more to the audience.
Yeah, that's a great point because I'm in mortgage in my day job, and then I do investing on the side. So I'm always using these terms and acronyms. So what equity is? Say, for example, you have a home, and the home is worth 700,000. If you have a mortgage on that, the home would be the asset. So the asset is valued at 700,000. If you have a mortgage on that, let's say for 500,000, that would be the liability. So your asset, which is the home, is 700,000. Your mortgage, which is the debt or the liability, that's 500,000. In that example, your equity would be 200,000. So in my example, I had equity in one of my investment properties. And what I did is I contacted a bank and I asked and applied for a line of credit. And so, what banks will do when there is enough equity in a specific property, they will give you a line of credit based off of the amount of equity that's in the property. Now, you'll never be able to use 100% of the equity in the property because the bank is always going to require that there's some equity left over. So, for example, if there's $500,000 of equity in the property, a bank may allow you to access up to 80% of it, or some banks 85. There are some credit unions out there that will even go up to 90%. So you do have the ability to leverage or access the equity in your home up to the majority amount of it. What's great about a home equity line of credit is that when you're not using the equity, you're not getting charged any interest. You're not having to make any payments on it because you're not using it. Now, if once you take a draw on the equity, at that point, if I borrow through the equity line from myself, then at that point I am having to make interest payments and monthly payments back towards the equity line. Does
And
that
for
make
somebody
sense?
that and for somebody that maybe doesn't have a lot of equity built up in their home yet, maybe they're, a newer homeowner, just bought their home a year or two ago. What typically is
Yeah.
the minimum requirement of equity to have before a home equity line of credit can be taken out? Is it 20% or it's a little bit more than that, right?
Yeah, it will change depending on market trends and overall risk. Right now, a lot of banks and creditors have tightened their credit guidelines compared to a couple of years ago as interest rates have gone up because it's considered to be a little more riskier right now than what it was. My bank, for example, on our first lien home equity lines of credit, we'll go up to 75 to 80%. On our secondary liens of credit, we'll go up to 85%. But I do know that there are credit unions out there that will go up to 90%. So, what that means is that on a 90% loan to value ratio, it means that you would need 10% equity in the property. And then 90% is the max. I'm a really big believer in that, regardless, if you have equity in your property, you need to have a line of credit. And the reason for that is because it's just an important part of your financial plan. Just because you have a line of credit, it doesn't mean that you need to use it. And as I mentioned earlier, if you're not using it, you don't have to pay for it. You're not making any interest payments. But by having it secure and set up, it is always going to be a financial security measure. So if there ever was a life event, if you experienced a loss of job, a loss of income, you would have this equity that you can draw from. I see so many people make the mistake of waiting until they got laid off or there was some type of health emergency. And when you need the money, a lot of times it's because there's some type of life event. You're not going to qualify for the money then. You're not going to qualify for a loan. So you need to make sure that when you don't need the money or you don't need access to credit or equity, that's when it's important to actually qualify for it. So on all of my investment properties, not all, but a lot of the investment properties that I have, I will set up home equity lines of credit on as many as I can as the equity builds.
And what are the typical rates at the moment for home equity lines of credit? Are they around 12, 14%? What are the interest rates that you're going to be paying on a home equity line?
Yeah, the interest rates usually are higher. Most equity lines are going to be in second lien position. And so what that means is that usually there's going to be a first mortgage, and then the home equity line of credit would be subordinate to that. So if you do have an equity line and it's in second lien position, it's considered higher risk. And so the interest rates oftentimes will be higher. I know there are some credit unions right now that are offering rates of in the sixes or sevens. But again, that depends on your overall qualifying factors. What is your credit score, your debt to income ratio? How much equity is in the property? How much equity is going to be left after you borrow? There are also first lien lines of credit. At North Point, for example, we have a product called the All in One, which is a mortgage, home equity line of credit, and a checking account built, more as a financial instrument than just an equity line. The interest rates on that are a little bit lower, but they are higher than a traditional mortgage. And again, I don't me personally, I'm not a believer in holding or putting a large balance on an equity line for a very long time. And the reason for that is because the rates do tend to be variable and they tend to be higher interest rates. But it's part of my plan though. It allows me to acquire these other properties, and then that's part two.
And the interest rate, like you just said, is variable. So, similar to, people that are staying on the sidelines at the moment, not wanting to buy a house, hoping that these interest rates will go down from 7% back into the hopefully the fives in the next year.
Mhm.
With a home equity line of credit, if we open up one today and a year from now the rates have gone down, that home equity line of credit is also variable. It's also going to be adjusting with the market, or is it fixed at the time that you open the home equity line of credit?
That's another great question. And ultimately, that is going to depend on what the financial terms are of the specific institution. Now, there are some credit unions and banks out there that will do fixed interest rates on lines of credit. However, that's not the norm. The norm usually is that a home equity line of credit is going to be considered a variable rate. And there's kind of two components of that. There's going to be the index, which the line of credit tracks, and the index is going to update usually every month. And then there's going to be the margin. The margin is going to be a fixed percentage that's built into the product. So right now, for example, the CMT index is around 5%. If you have a margin that's at 4%, your final rate is going to be the index plus the margin. So in this case, 5% for the index plus 4% for the margin would equal 9%. Now, kind of to your point, what if in 2 years from now that index comes down? The index is the variable part, the margin is the fixed part. So if that index went from 5% down to 3%, well, the overall interest rate would then be calculated as 3% for the index, 4% for the margin. So the total rate would then be 7%. So a lot of times home equity lines of credit will, track the market. The opposite can happen as well, where if the index goes up, if it goes up to 7% and the margin's 4%, then at that point the rate would be 11%. So there can be more risk as far as having a larger balance on a variable rate product. But again, though, it comes back to that question: what is the plan? What is the goal? And what are you looking to accomplish? And how are you going to go do that?
The only 2 cents I'll add to that before we go on to part two of this, just from a realtor's perspective, is that people are very respectful of a home equity line of credit, and really just understanding that this doesn't mean that you just have this all of a sudden additional money to spend. It's not the way to now be able to afford your vacation to Hawaii, as an example. And a reason I say
Yeah.
that is, if you guys are familiar at all with the term bringing cash to closing, what happens a lot of times with sellers is they bought a home, they've taken out a home equity line of credit, they've got a large balance due on that home equity line of credit that they need to pay off
Mhm.
at the time of selling their home. So if you have a $100,000 home equity line of credit on your house and you've used $80,000 of that, you go to sell your house, and there's only going to be about a $40,000 profit at time of sale. You're going to actually have to bring money as the seller to closing just to be able to release that lien and transfer the deed over to, or the title over to, the new homeowner. So there's times where people can get upside down on their home and then be in these predicaments where they want to sell, but they don't have the cash available to bring to closing to sell their home. So just be very
Yeah.
mindful of that.
I'm so glad you said that, because right now Americans have record equity in their homes. I recently read an article and it said that over 40% of single family residences in the United States are free and clear. And at no point in history have Americans had more equity in their homes. And so what that means is that Americans are wealthier than they've ever been, but at the same time, affordability, because of inflation, because of the cost of goods going up, the fact that wages have not kept pace with some of the costs, affordability is, you know, lower than it's ever been. So there's this interesting predicament where Americans are wealthier than they've ever been, but at the same time they're having a difficult time meeting some of their day-to-day needs. And so the point that you made there, your equity, this is not to go on vacation. This is not to go finance a car. It is not for consumer purchases. It's about being smart, about being responsible, and using your equity to accomplish your financial and real estate goals. And here's the reality, what we're talking about is probably not going to be appropriate for the vast majority of Americans out there, probably around 78%. And the reason for that is because most Americans just aren't serious when it comes to their money. They have a consumer mindset. They're looking to spend first. They don't take their saving or their investing seriously. And if you don't have the discipline and understand how this works, you don't want to do this, because you can, to your point a minute ago, get yourself into trouble. You need to have, if you've never done this, you want to talk with someone who is a mentor, you want to talk with a real estate professional, you want to talk with a lender that you can trust, and make sure that you're going about this the right way.
Very well said. Cool. Well, let's jump into part two of this. I'm anxious to hear kind of how this deal all came to the finish line.
Yeah, so kind of to just recap part one really briefly. There was this duplex for sale. I used my home equity line of credit to pay cash for the duplex. Even though I paid cash, I didn't use any of my cash. The duplex was in Oklahoma. I paid $230,000 for it, and I used 100% of the funds for that from my home equity line of credit. So what I do now, so now on the day of closing, the duplex in Oklahoma doesn't have a mortgage on it, but now there is a $230,000 balance on my home equity line of credit here in Colorado. Does that make sense so far? Okay, so now the goal is to get that debt moved over from the Colorado property to the Oklahoma property. So what I did is I contacted a local bank in Oklahoma, and the local bank was willing to allow me to take out debt on the Oklahoma property through a cash out refinance. And I used that to then pay the home equity line of credit back. So they actually gave me a loan for the entire $230,000 to then go pay my home equity line of credit balance back 100%. The reason that they were able to do that, and the reason that they did do that, is because when I bought this duplex, it was actually worth over $300,000. When I refinanced it, I did have to get an appraisal, and that appraisal came in around $325,000. So because we found a deal that had so much equity in it, the equity was already there, and that served as kind of my down payment, and that's what allowed me to get all of my money back to then go pay off the home equity line of credit. Now, keep in mind that there's already two tenants in this property making rent payments every month. That's another important part of the analysis here. The amount of rent that the tenants were paying was going to be about twice as much as what the mortgage payment was going to be. So not only are the tenants going to cover the entire monthly mortgage payment for the new loan on the Oklahoma duplex for the principal, interest, property taxes, and homeowners insurance, but now there's still, roughly $1,500 left over. Each unit, each side there is being rented out for roughly $1,500. So the first $1,500 is going towards the mortgage payment, and then the second 1,500 is positive cash flow. So at the end of the day, now I didn't use any of my own money. I didn't actually put a down payment. I didn't put any of my money into this deal at all. So now I own an additional property. It has anywhere from 120 to $170,000 of equity in it. So I'm 120 to $170,000 richer. I have two tenants. The mortgage debt is now being paid by someone else, and I have monthly cash flow coming in as another source of income. So my net worth grew. I have more income coming in, and I didn't use any of my own money. Now, the reason that this worked and this was such a great opportunity is because my brother and I were able to find just a great deal. And that's why, if you can find a great deal, this is one of those diamond in the rough types of deals where this seller, I don't know what the full story was, whether she was distressed or looking to just get out of it, but she sold it at a huge discount. But the reason that I was able to close in 10 days and make a cash offer is because I was able to use and I understand the power of how to incorporate a home equity line of credit, converting that into a cash offer.
So I know a lot of listeners are probably saying, well, Ben's just lucky. That's a 1 in a million type property. I don't have the luck or the ability to find something like that. The only thing that I would kind of counter to that is yes, that might be one extreme, a home run, but there's also just a lot of opportunities where they're not necessarily a, diamond in the rough, fantastic deal, but as long as you're at least finding good deals, another opportunity to do so with that, another opportunity to take that and make it work is using what we call the Burr strategy, where let's just say that you're able to find a home in Oklahoma that's, let's just say it's $100,000 and it's listed for 100,000, is probably actually worth more like 120,000. As long as you're able to, let's just say, pull 150,000 of equity from your current home, you can buy that home in Omaha for 100, put in some renovations, some sweat equity. And before I continue on this, I'll just give you guys the acronym. BRRR is BRRR, which stands for buy, renovate, refinance. Buy, renovate, rent, refinance, repeat. So basically, you're buying it, you're realizing it's a good deal, you're renovating it, hopefully doing some of the work yourself or finding some good deals on
Mhm.
contractors where you're minimizing your costs for renovation. Then you're renting it at a higher dollar amount for each of the units that you're buying, getting that
Yep.
increased cash flow of rent. Then you're going to the bank and having it refinanced, showing this additional value of the property. Once you've refinanced it, you're able to then pull that equity of that larger dollar amount of value of the home out, and then you can repeat, meaning going on to the next property. I'd like you just to kind of maybe add your spin on that, just for people that, again, are looking for some advice on not finding that home run deal that you found, but realizing that there's still a lot more kind of typical deals out there, especially in markets like Omaha.
Yeah, that's so important, and it really comes down to the education and really developing your skills. Now, I will admit I got lucky. We found a seller who is very motivated to sell. Most sellers are not going to be like that, but the reason I got lucky was because every night when I was going to bed, I would spend 45 minutes to an hour looking at all of the available duplexes for sale in Tulsa. And when you do that night after night, week after week, month after month, you get you have the ability to put your thumb right on the pulse of that market. And so you know what, how much homes should be selling for. You understand what an appropriate price per square foot is. You understand what the market rents should be. When you're looking literally at dozens and hundreds and thousands of homes, and it doesn't have to be overwhelming. You just get set up on a search or you pop onto Zillow every night and you start educating yourself in the market. And that's what I did. So when this property popped up, I said, time out. What's going on here? This is way below market value. And I never even went. I still to this day have never even been to the property. I never, I did have it inspected, but I did not go and look at the property. I did not, fly in and look at both units. I didn't do that. The reason for that is because over the years, I've been able to develop these skills where I have enough confidence to where, I don't feel that I need to do that. Also, my brother is out there and he's someone that I trust. He's a partner and we work really well together. And it's not about, just doing this on your own. It's about developing a team. So he's out there. His wife does property management. He also has a team of construction guys that he works with. So whenever we have any real estate deals in Tulsa, Oklahoma, we have an entire team already set up: property management, rehab, construction, handyman, inspection. Our entire team is already, our network is already built out. Same thing in Tucson with the short-term vacation rentals. Down there, we have a specific handyman. I have a pool guy. I have a hot tub guy. I have someone that works on the irrigation for every property. And that's what's, kind of a lot of times left out is how important having a reliable network is in a lot of this stuff. And that's just as important as kind of finding some of these deals. So when you do find a deal, you have a team of people that can help facilitate the acquisition and then the management and the oversight, because it's so easy to get taken advantage of or not do things correctly. And these are the things that you want to watch out for. So understanding the importance of, building those connections, those relationships, and then having the ability ultimately and the confidence to pull the trigger on some of these things.
Yeah, very, very inspiring hearing that. You guys, if you're, very new to investing, a couple recommendations I have for you. One is get connected with Bigger Pockets, really good network of investors from all skill sets and sizes, from people that don't own anything to people that have thousands of units, but also kind of identify, where you're interested in, and then just go a mile deep in that area rather than just kind of being surface level at a bunch of different places, just saying something like, yeah, maybe I'll invest in, Texas or Oklahoma, maybe Kansas. You need to really do the first step, in my opinion, is really identifying where you want to be located, and then being able to develop just some very, kind of, I like to use the term like a napkin math, or just being able to just have a few things
Yeah.
that you're really just competent on. So one would just be in whatever neighborhood you've identified. Let's just use Omaha as an example, getting a feel for what the going rents are in that area. You can use tools
Mhm.
like rentometer.com. That's a really good one where you just type in the address or the zip code, 2 bed, 1 bath, whatever the unit type is, and it'll give you a range from low to high and also the median average of rents for that area. And once you've established that, you can do what's called the 1% rule, which is basically just looking at a property and the total cost of the home. Let's just use $100,000 as an example. You want to be getting 1% of the entire value of the home. You want to be getting 1% as monthly revenue from your rent. So if a $100,000 home is getting $1,000 a month in rent, then you're basically meeting that 1% rule. The 1% rule is a little bit harder to make work nowadays, especially in places like Denver. There's no way in hell you're going to do it in Denver. It's going to be a
Yeah.
0.25% rule. But I think in places like Omaha, that's still very achievable. And having just some simple, again, like table napkin math, just being able to use some scenario like that to identify properties at first, and just start working with that, and then getting more and more educated and versed like Ben is.
Yeah, because what you're talking about is having the ability and the skills to identify a possible deal. And if you can do that napkin math, you can say, time out. You know what? We need to take a deeper look at this. And then to your other point, I'm really a big believer in that saving and investing in 2024 is more important than ever. And the reason for that, like what has happened to housing? Housing has gone up exponentially over the years, especially when you compare the cost of housing to generations before us in the 50s, 70s, 90s. What's happened with the cost of education? Well, that has increased substantially as well. What about inflation? Our wage growth is not even keeping up with inflation right now. And so, what that means, for example, this is a story that I share frequently, and I may have even shared on this podcast before. My mom, growing up in the mid 90s as a single mom, working not even full time, was able to buy a house on her own and make the mortgage payment on her own in a west suburb of Denver called Wheat Ridge. Like, think about that. And she was able to buy a home in the west suburbs of Denver for 130,000 and make the payments on her own. In 2024, that could never happen in Denver, in the Denver market. And so what that means is that a lot of people are going to have to start looking at other markets to invest in. So if you don't start investing, you will get left behind. You can't, your dollars in your savings account are going to be worth less and less and less. And learning how to invest is a skill that we're all going to have to really foster, nurture, and develop. And that might mean investing in a market that is outside of the market that you live in. That can sound very intimidating and impossible. I'm here to tell you that it's not impossible, but it is going to require some work, some education, some discipline, and then making some connections. But it is possible.
Super inspiring. Thanks so much for sharing that, Ben. I think that was one of the most valuable podcasts we've had to date. And I think just to kind of close this out, I want to just implore everybody listening that if you are interested at all in this kind of stuff, Ben and I are both very reachable and available, and would love to, chat on a phone call or grab lunch and just, help kind of figure this out with you. And also even consider down the road, maybe even partnering up on a deal. There's so many different ways to get creative when it comes to investing. And the first step, we've talked about a lot of steps here, but one of the things I think that's really important is just building out that network, that just group of people that you're surrounding yourself with that are like-minded and have that same just aspiration of getting involved with real estate investing. So just want to, again, share that if anybody out there is wanting to connect, we would love the opportunity. So please do so.
Right. Thank you so much for your time. Thank you for giving me the platform to share one of my stories. One message that I have is write down your goals, have a vision, and believe that you can accomplish those.
Love it. Well, you guys, hope you enjoyed this episode of The Pursuit of Progress. Once again, please, if you haven't yet, hit that like and that subscribe button if you're watching on YouTube. And if you're listening on any audio platforms, please share this with a friend. If you have anybody else out there that's been talking to you about investing or just any sort of real estate interests, we would love to grow our audience. And the best way is just through word of mouth and sharing the show. So please do so. And we look forward to a new episode next week with my co-host Ben on The Pursuit
Pursuit of progress.
Catch you guys later.